welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing that we need to do is open up our brokerage platform. I like to use Tasty Trade. You can use whatever you like. And of course, we're going to be writing options contracts, so we need to know where we are in the options cycle. So if we head over to the trade tab and we just pull up any underlying, we can see here we've got a list of expirations, right? Everything with a orange W is a weekly. Everything else is a monthly. Our next monthly is 25 days away, October 18th. That is a bit too close for us. So we are going to go to the next one out, which is November 15th. And that is going to be about 53 days away. Okay, so now we know our starting contract length is going to be about 53 days. So we can come over to our watch list and filter out everything that has earnings between today and the next 53 days. So what we'll be left with is a list of underlyings that does not have earnings over the next 53 days. So everything here is good to go. It has a high liquidity level. We've also filtered out the low liquidity level stuff. Everything here has a high liquidity level and does not have earnings. The reason why we don't want earnings is because earnings will end up disturbing our position. It will increase volatility, it can mess up our deltas, and it can have a negative impact on our P&L essentially. Earnings, if you want to do earnings, you can do that, but it's a completely separate play. We're just going to talk about the basic bread and butter for your portfolio. So if we just go down our list, we just want to see what would fit well in our portfolio. This is what our portfolio looks like currently. You just want to make sure you're not too heavy in any one thing. So we've got GLD. We did a video on GLD recently, so I think we'll miss GLD. We've got silver, EWZ, GDX, we got oil, USO. Let's have a look at USO. We want to stick to things that have an IV rank of over 50. Over 30 can be acceptable as well, depending on what the underlying is, but generally speaking, over 50 is considered high. So if we have a look at USO, go over to the trade tab, open up the November 15th expiration, and now we can see the options chain. The first thing we want to do is have a look at the spread. Okay, so as we can see here, the spread is 40 cents wide there, 40 cents wide. I mean, I'll be completely honest with you, the spread by no means is the best. Definitely not the best, definitely not great even. So USO, you might want to trade this, you might not want to trade this. I would probably lean towards not trading this. And let's see if we can pick up or spot something else. In fact, let's just have a look at silver. We did GLD. Let's have a look at silver. We haven't done a position on silver yet, I don't believe. We've got an IV rank of 57.3. We've got 4 out of 4 stars on the liquidity indicator. It's currently trading at just under $30. So this should be a nice small trade. And it should be suitable for all accounts, including small accounts. So we've got the silver options chain here, and this orange bar shows you the expected move of the underlying over the next 53 days. And this orange horizontal line shows you where price currently is. So what we want to do is we want to be selling strangles ideally, and we want to sell strangles about 16 to 20 deltas out. So we've got 19 deltas on the call side, and if we go over to the put side, we've got a 15 delta on the put side, which is a little bit light, but the next one up from there is 24, which is a bit too heavy. So we've got 19 delta and 15 delta, and this is called a strangle. We sell one call and we sell one put. So our strikes here are at the 25 and 32 price level. So if you mark that onto the graph, 25 and 32, as you can see here, we've we've mocked up a position from before. So 32 there. And then if we go to 25 on the put side, we're basically at 25 already. Perfect. So this is what the strangle would look like in silver. As you can see, price has stayed within this range over the past couple of months. We are smack bang in the middle of this new range that we've created. Of course, volatility does seem to be trending downwards. It has had a little bit of a spike. Hopefully we can see volatility keep contracting and see volatility come out of the market a bit more. And overall, this on the chart is looking like a nice textbook position. So if you just look a bit more at the numbers, let's see what we've got here. So we can collect 62%, 62 cents up front. That's 100 shares per contract. So that's $62. We collect $62 up front. Our broker is going to require $280 in buying power to open this position. So this is not a bad return on capital, to be honest, for a naked position. We'd get $1.69 in daily theta decay, and we'd have a 74% chance of being profitable on this position, and there's an 86% chance of being 50% of hitting 50% max profit at some point over the next 53 days. That's just gone up to 88% now. So we're looking at between 74 and 88% chance of success. This is a very high probability trade. It only requires $280 in buying power. So really and truly, everybody can put this position on in their account. It doesn't matter how big your account is. And that's basically what it looks like to find a position in SLV, and I think that would complement our portfolio quite nicely. There is one other thing that you do need to keep in mind when you are looking for positions, and that is the size of your positions. What you need to do is use our position sizing template, and this will prevent your account from blowing up. It doesn't matter what you do. If your sizing's wrong, everything's going to be wrong. So you enter in the size of your portfolio. Let's say if it's $10,000, you then enter in what the current VIX level is. Let's say if it's 14.2, everything below will then be automatically calculated for you. All you need to do at this point is just use the information to form the backbone of your portfolio. It will tell you how much buying power to allocate to undefined risk positions, defined risk positions, how much of your portfolio you should allocate to short premium in general as well. And there's also an explanation of everything there. You can get this for free, completely for free. Click the link in the description, head over to the free position sizing template, and you can pick that up. If you do want to get involved on our trades and see what positions we've got on and basically copy our portfolios, make money with us, again, click the link in the description, head on over to EDS Premium, get yourself signed up. You will be able to get access to all of our portfolios, large and small, so there'll always be a position for you to copy. There is a full course included, so no prior knowledge is required. We will teach you everything you need to know. It allows you to learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money-back guarantee. So if you studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free, and right now it's £1 a month. The price will be increasing. However, once you're in, you don't need to worry about price increases. So you are rewarded for getting in early. We have just launched. That's why it's so cheap. So get in, and I'll see you guys on the inside.